Essentially, backtesting limitations arise because markets evolve. Trading patterns and behavior can change due to factors like macro environment, market regulation, and investor sentiment. And often the biggest opportunities are caused by these past comparisons breaking and disconnects that are created in the market. Backtests are only as good as our inputs, and sometimes though we don't realize where our blind spots are, especially if we have a system where we're getting more aggressive as erroneous or faulty inputs tell us a stronger and stronger message. It gets more and more dangerous. If you're going to do a trade, especially as a developing trader, it's so important that you're very intentional and you learn and you try to pull on those threads and suss out those details. And if you're doing a trade, you really want to go back and figure out like, okay, why did I trade this? What was the setup? What were the variables that made this good? How should I have traded it? And then collecting some of that data kind of going forward and everything else or backwards, that deliberateness, that's where the real growth happens. No system you come up with is going to be perfect. No strategy you come up with is going to be perfect. And by definition, a lot of times we just don't know what we don't know. And you can be blindsided by so many things. And so the most important thing is to like size way more conservatively, always leave ammo in the tank, and just give yourself the most important thing, which is the runway to always be in the game to learn and add new patches on your armor. The more you tie your identity to performance, the more you're going to struggle. Like if you're afraid of making mistakes, then you're not going to have a fun time and you're going to do yourself a dishonest disservice.
All right, welcome back, everybody. It's my honor to introduce our next speaker for the Trailline Conference. We have Lance Breitstein. Many of you guys are already familiar with him. He was able to present last year, which was fantastic. Highly recommend checking that video out as well. But Lance, for those of you who aren't familiar with him, is an ex-Trillium top trader. He has made over $10 million trading multiple years. He is also the founder of the Impact Competition Foundation, whose aim is to solve social issues while providing real-life experience to students in problem solving and entrepreneurship. And today, as you can see right here, Lance will be presenting today on the limits of backtesting. And Lance, it's great to have you back. Really looking forward to your perspective, which is a little bit different than, some of our kind of swing traders as well. But of course, with all successful traders, there's key principles and takeaways that you can take from every style and time frame. So thank you so much for your time. And yeah, looking forward to this.
Thanks, Richard. It's great to be back. And last year's presentation was a huge success. And even to this day, the amount of times where I'm still getting positive feedback from that presentation, or where I'm citing that, where people are asking me about some of those trend following questions and how to define trends, so often I'm still referencing that. So hopefully this will be another banger. And for those that are curious, on Twitter, all of my achievements in P&L is either verified by Trillium or Kinfo. So I am 100% the real deal because those questions always come up. And I think it's good for people to ask that. And today I will be presenting on the limitations of backtesting, one of my favorite subjects, because I think it kind of adds a lot of controversy, especially for a lot of people that rely on backtesting to find their edge and test their edge. And let's dive into it then. So first, for the audience that may or may not be aware, what is backtesting? Good old trusty Investopedia says, backtesting is the general method for seeing how well a strategy or model would have done after the fact. It tests essentially the viability of a trading strategy by discovering how it would play out using historical data. If backtesting works, traders and analysts may have the confidence to employ it going forward. So what does this really mean in just explain like I'm 5 years old terms? It says we're going to look backwards in our stock data and just test our basic assumptions. So you might wonder, do stocks go up on the first day of the month? Right? For a long time, there was the theory that, pension funds, 401ks, all that stuff, all those inflows tend to occur on the first day of the month. And that as a result, there is a little gap where I think a lot of traders might have heard the very famous Santa Claus rally, which is that in December, around Christmas time, going into the new year, everyone's feeling good, everyone's jolly, there's a lot of money flows going around. And as a result, the stock market tends to go up with it. And so backtesting is a means of testing a lot of these simple seasonal or cyclical or whatever things. A lot of just any pattern can be backtested. And as a fun fact that I think really surprises a lot of people is, for the most part, I barely backtest anything. If I were to look at my trading that I've done this year, and really here in 2024, the first half is over, and my God, has it been an active year between the moves in Bitcoin, between the moves driven by AI and the semiconductors, between the moves in GameStop and AMC with Roaring Kitty that we're definitely going to dive into. Not a single trade that I've done this year have I had any form of hard data on. Not a single trade that I've done has been back tested. So for a lot of traders out there, that is kind of a mind-blowing fact. Like, wait, how do you know it's going to have edge? How do you know it's going to work? And so first, I want to preface this whole presentation by saying backtesting is absolutely a useful tool. There is nothing wrong with backtesting. For many traders, especially on the higher timeframes, especially the more quantitative ones or the more programmatic ones, or even for beginner traders that are asking the questions, do I actually have edge? Which is a very important question to ask. Backtesting can really help you decide that. But the point I want to make with this presentation is that it is just one tool, and it favors more quantitative styles of trading and more simplistic scenarios that are testable versus other things. And my whole issue, though, is from my experience online and interacting with a lot of traders, backtesting is widely used, which again, great, but many don't recognize its limitations. And that's really what I want to, I guess, educate people on and make people think a little bit and kind of question some of their own actions and beliefs. So we're going to start off on a very morbid note using a little thought experiment. And that is, what would happen if Russia launches a nuclear weapon? Something nobody ever wants to think about or imagine. And thank God, this scenario has not yet occurred. But if you were to ask a traditional backtester, like what's the play here? What's the game plan? How are things going to respond? A backtester would immediately run into problems. First of all, it takes time to do a backtest. It requires some thinking. It requires some assumptions. It requires you to potentially find examples that, right? Thank God, very, very limited nuclear weapon use. It's not as if we're coming up with 30 data points, thank God. And so as a result, you would need to go to some lower tier comparables. How does the world act during wars and finding those comparables, those dates, yada, yada, yada. There's definitely some complications. And while that happens, I would argue that the discretionary trader is already making all the money or all the easiest money. Because while you try and do that analysis, markets are moving. And I can guarantee you VIX is exploding. Certain equity risk markets are going down. Safe havens are potentially going up. And my point being roughly made is that these are some of the things we need to think about when we do these back tests. So this probably doesn't cover all the limitations, but I really try to think about like what are the main ones that people should be aware of, but I see often aren't. And so the first one is the situation has no direct analogy. What do you do for something that has never happened before? Or number two, the market has changed and previous data is misleading and dangerous, or even just totally obsolete, which does happen. The third is the back test is making faulty assumptions, things that are just dead wrong and can get you in a lot of trouble. And four is the back test is overly simplistic and missing key nuances. And I think really number four is probably the issue I see most often being made. Like I think people recognize that, okay, if there's no good analogies, you can't really use backtesting. If this hasn't happened historically, that's fine. But I think where people run into the most trouble is they do these backtests and they're just too simplistic and not touching on a lot of nuances that would otherwise help really determine the outcome of that backtest. And then what this really ends up as is, when do you even know that a backtest is missing something? Like, when do we ask these questions in our process? And that's something that's so important for people to think and have a real step or a process carved out for knowing, hey, I need to really do some deep reflection on this. So let's dive in. Number one, times when the situation has no direct analogy. So by definition, we can't backtest any opportunity that doesn't have relevant prior data points. And I would argue this very strongly, and I think is probably one of my strongest points on this, is the most opportunistic trading environments are when things are the most uncertain and back tests are the most useless, right? If we were to take COVID-19, I mean, what did we really have to go off of where the whole world is locked down? I think people made the analogy to the Spanish flu and I think like 1913, but like I don't know, was there really that much great market data then? Were the same products really around back then? So even COVID immediately started to pose a problem. How long do lockdowns exist? What will the effect be on long-term travel? Will people stay working from home? Will people use Zoom forever? What are the implications going to be? Really, really hard to know. But at the same time, there was so much uncertainty and the price moves were so enormous and there was so much strain on the system that there were incredible, incredible opportunities. And that was when I think most traders made some of the best money in 2020 and 2021. And that was when there were also some of the least comparables. Another one being modern monetary theory. Interest rate policy by central banks actually isn't really that old. And up until 2008, we had pretty normal interest rates, and we ended up having very low interest rates for a very long time. And a lot of people said interest rates can never go negative, this or that. Sure enough, we end up with negative interest rates. We end up with near zero interest rates for over a decade. How do you really know what the implications are? For a long time, people said there would be inflation, but there wasn't. And sure enough, eventually it caught up with us where we currently got inflation, call it in 2022. But people didn't know, and there wasn't a comparison. And even with something like Bitcoin, can you necessarily say that there's been any comparable to a cryptocurrency? So when crypto has offered some of the greatest compounding opportunities and trading opportunities ever, how do you really know what to base some of these backtests are off of, depending your time frame, on something that hasn't? I mean, how many products have we seen that start off at, I don't know, uh, tens of hundredths of a penny, then become 60,000 plus in value? We've not seen something like that. At least I can't think of too many off the top of my head. So often traders that need these comparables are going to have some of their weakest tools kind of when the opportunities are biggest. And I think that's a big problem. If you don't have any other tools in your toolkit, that's going to be a problem for you. So let's dive into some of these. I would argue that in 2022, some of the biggest trends were kind of created from CPI, and it was the best theme for swing trading, for day trading. And what happened is for the kind of 15 years prior, CPI was pretty much nearly a useless data point. There was not a single day trader in 2018 or 2017 or 15 running into the office for the 8:30 a.m. CPI number and saying, "Oh my God, like what's my game plan? What's going to move?" For the most part, it was just a non-event. There wasn't inflation. There wasn't any inflation in sight. And so all of a sudden in 2022, the narrative changed. All the stimulus started to change the market environment. And so I work with a very talented seven-figure trader. And at the end of the year, we were reviewing his year, which was not as good as he wanted. He had underperformed in 2022. And I said, hey, man, like the big difference between you having an okay year and you having an awesome year is you missed one of the best themes. You didn't trade these CPI themes. And he said, well, yeah, Lance, like the problem is I didn't have any data points before. Like I didn't have a game plan. There was no way for me to do that analysis. And I said, well, yeah, that's what made it so good. The regime was changing. And a lot of people that are looking for data or looking for this, by the time you get that data, if you wait a year, CPI and inflation is now already kind of price adjusted. Market participants have changed. So instead of using alternate methods and is noggin a little bit to get involved and say, oh, wait, oh my God, like after the first data point where things come in hot and you see a big market move, that's when you start wanting to pay attention to the second or third and game plan it. And you can use different methods, which I'll get into at the end, but you can say, wait, if all of a sudden high inflation is bad for risk assets because that means the Fed is going to hike rates, you can still develop a strategy. And so his reliance on data there, but not having relevant previous data, actually really hurt him and affected his year. Um, there's also the example this year when Roaring Kitty is back. We all know the story here. I don't think I need to belabor that too much. But what do you do when you see a tweet like this, right? People wonder, like, why do day traders and traders still have jobs? Why has it not all been programmed out? Well, I think when you feed an AI program this tweet, AI says, what? I do not understand, cannot compute. What is the relevance of a meme? And what is the relevance of, this roaring kitty tweeting, right? How many people had AI programs scraping this? Pretty much nothing, right? And I would argue there's no AI on Earth that is going to be able to deduce, oh my God, roaring kitty is back, therefore must buy GameStop. And the only way it would have been able to do that if it was instructed to do so with explicit logic from a human. And I would argue, recognizing that meme mania might be back because of this, and oh my God, I might need to buy GameStop. This happened on a Sunday evening, but what happens if that happens midday? Um, do you have a backtest you need to run? And even if you did, you can't figure out what the action is. When kind of day trader discretionary Lance is like, oh my God, if this happened during market hours, I'm just buying max buying power, GME and AMC and anything remotely memey, YOLOing in some calls because it's asymmetric to do so, even without the data. So there's also times when the market has changed and the data that does exist is obsolete. Essentially, backtesting limitations arise because markets evolve. Trading patterns and behavior can change due to factors like macro environment, market regulation, and investor sentiment. And often the biggest opportunities are caused by these past comparisons breaking and disconnects that are created in the market. So uh, long-term capital management is kind of a more famous story from the late 90s. And it involved some of the smartest people in the world, Nobel Prize winners, economists, all sorts of mathematical geniuses that are far smarter than me and probably far smarter than all of us. And they had been outperforming the market using a lot of back tests and quantitative methods for pretty much a good couple years. They were just walloping the market. They looked invincible, and it was very lucrative. And $4 billion in AUM back then is pretty enormous. And so then what happens is there was a financial crisis, and in 1998, some of the correlations around the world started to go to one. And I think it's become more popular and more acknowledged over time, even in 2008, that when you get really, really bad economic events, like take COVID, right? COVID was a global event. So many correlations of the world, all of a sudden, the whole world economy was linked by this one virus. And when the whole world shut down, everything was hurt together. And so what happened to long-term capital management is they ended up blowing up. They essentially lost 100% of their assets because they were overly reliant on some of their backtesting data and not recognizing that, oh man, the patterns that we're making money in, sometimes these patterns break down. And when that does happen, oh my God, we are going to be absolutely screwed. And again, going back to my original point, when things break and companies with huge AUMs end up screwed, this is when you get some of the most lucrative dislocations. So if you're properly positioned and you have liquidity during times like this, whether it's 1998 or 2008 or during COVID in 2020, you can make magnitudes more than you ever imagined if you're properly positioned and not caught up overly relying on the data. Again, another morbid example. I don't know. Guess I was in a morbid mood making this, but the Trump assassination attempt we saw a couple weeks ago. So what backtest will tell you, what assets to buy and how they'll necessarily perform. So if you were to generally just think some of this out or rely on past data, an assassination attempt, of course, is generally not good for for risk assets. Bitcoin is generally one of the kind of biggest risk assets these days. It's highly correlated with risk. And what ended up happening is, despite a very small initial dip, Bitcoin ended up exploding over the weekend and into Monday. So what happened? Essentially, despite this being an assassination, the more causative factor was that Trump has come off as very pro crypto. People view that a win for Trump is going to be good for crypto prices. And so when he came away unscathed, that was actually extremely, extremely good for Bitcoin. It's not as if the NASDAQ did that much. The S&P, like the NASDAQ, IWM markets overall, like the broad indices, didn't do anything that meaningful. Bitcoin absolutely exploded. That's not going to be in a backtest. There's no way to figure that out, really, without prior data, which just doesn't exist so well. You can get a lot of conflicting signals. And so now probably one of my favorites, because I almost got absolutely tore up in this, which is pretty damn funny. Well, I guess not at the time, but very funny. Even at the time, it was funny, to be honest. And so this was during COVID. This is in, I believe, March of 2020. So gold and gold miners are generally a safe haven asset, right? In times of panic, people will push money into gold as a store of value. And so generally, gold does well. Gold miners are linked to gold. So COVID comes, GDXJ, which is small cap, not small cap, but the junior gold miners, they get absolutely walloped. These junior gold miners fall over 50%. And not just that, but GDXJ is an ETF. As we know, ETFs generally trade at their net asset value. This ETF, because there was such a massive liquidation and funds were blowing up, this got absolutely smoked. And this started to diverge, especially on those bottom days there. This hugely diverged from their net asset value by, I think, at least I think it diverged by close to 10%. So imagine being some quantitative fund and you get a divergence from NAV when always this is pretty much perfectly linked. Why is it perfectly linked? Because you can just totally arbitrage it. Generally, you can short all the underlyings of the ETF and buy the ETF when in discrepancy occurs. Instead, this just absolutely blows out. Not only did it fall greater than 50%, but it was like 10% from its net asset value. And if you're overly reliant on the data, like, what's the play here? How do you handle risk and how do you handle these situations? It's very, very, very difficult and it's very, very dangerous. And so that brings up the point of faulty assumptions. Backtests are only as good as our inputs, and sometimes though we don't realize where our blind spots are, especially if we have a system where we're getting more aggressive as erroneous or faulty inputs tell us a stronger and stronger message, it gets more and more dangerous. So taking that GDXJ example, if you're like, oh my God, a discrepancy or a divergence from net asset value in an ETF, especially one as liquid and global as GDX and GDXJ, if you think that's free money, well, guess what? It was free money at 3%, it was free money at 5%, and it was free money at 10%. And you need to be able to hold through all sorts of that stuff. So it can get really, really messy. Spreads often can blow up, and things that a backtest might say, like, for example, sometimes with mean reversion, hey, this bounces 80% of the time, and this is the expected value. But if that just keeps going and going and going, when do we need to wonder whether we're actually missing something and our backtest is not valid? So this is another example that came up with one of the traders I work with. What we see here is a recent chart of Apple back in June. And I believe it was on June 10th towards the close, it came out that Apple was going to collaborate with OpenAI for ChatGPT and some of their AI. And so essentially Apple went down on that headline because people were thinking, oh, Apple's kind of folding the AI race. They're not going to be a player. Like, this shows how no longer they're innovative or whatever else. And so meanwhile, Apple the next day absolutely explodes and makes a multi-standard deviation move higher. And so one of the traders I work with does a lot of good backtesting, and he's very, very smart, sharp guy, seven-figure trader. And Apple starts to explode higher. And not only that, but Apple had a huge level on the daily at $200. And so it breaks $200. And now we're really talking. I mean, I can't tell you the exact prices just off of this, but Apple went from what, roughly 192 to about 210. and then the next day we touched 220. So, that's over like that's almost a 15% move in Apple in 2 days. That's almost unfathomable. And guess what? Depending on how you code that backtest and how you view markets, that isn't even on news. The news happened the 2 prior days. So you can get really, really, really twisted doing that analysis. Now, though, if you use other methods, it's very easy to say, oh, wait a second, like that assumption's wrong. What happened was the market realized that this collaboration is going to actually be very, very good for Apple. And what we perceived initially as being bad for the company, now not only is it good and you got to retrace all that and then some, but then when you break out, that's a huge tech breakout in a momentum market. And so all these factors are coming into play and leading Apple to make a really, really, really big move. And if you're on the wrong side of that, you are not going to have fun. And not only that, but you're missing one of the best breakouts of the year. How often, in most years, Apple, I would argue, probably shouldn't even be moving 10%. And so then to capture like a 10, 15% move in 2 days is pretty damn incredible. Then if you start throwing options into the mix, you can do amazing, amazing plays, which might otherwise be the total opposite of what your backtest tells you as far as standard deviations. And so then, even if we look at an intraday perspective, I would argue these nuances matter. This intraday, nowhere were we that extended. It was very, very steady. It was very, very strong. And when we're not analyzing that stuff and we're taking too simplistic of an approach, that's where you get in trouble. And the play gets better and better. If you liked Apple at a 7% move or an 8% move, what are you going to do when it moves 10, 12, 15% in 2 days? You get twisted and you put yourself in some real bad positions. The other thing, and many a trader blew up on this, was back in February of 2018. And this, I think, was one of the most important points of sometimes we just don't know what we don't know. And the volpocalypse occurred where volatility, the VIX, was just really chronically low. The market was very, very boring for a long, long time. Trading was pretty boring for the most part. And then all of a sudden, there started to be real risks. And all the hedge funds and all the firms that had been just rolling over short vol, all of a sudden, it was everybody going for the exit. What happened was VIX started to explode. UVIXY and SVIXY are inverse vol ETFs, and those started to explode. And what then happened, though, after hours was during the day, they were totally linked, doing their appropriate. I think these were like 2x inverse vol. But then after hours, these just started to absolutely implode. And if you go off any of the data or any of the correlations or any of the rules, like this shouldn't be diverging from the VIX. What was happening was that somewhere in this 250-page prospectus is a liquidation clause. And we're now talking 6 years ago. I can't remember the exact terms, but it was something to the effect of if the VIX rises X% and if net asset value falls below a certain amount, these ETFs are essentially just donezo. They're wrecked. And people knew about that clause. I think probably virtually every retail trader and every day trader probably was not, at least 99% was not well versed. And so if you're thinking this volatility, vol is going to mean revert, vol always tends to mean revert, right? If you were playing it and playing that divergence, you don't know what you don't know, which is, oh my God, there is a clause in this prospectus that will just absolutely blow me up and I can lose 90% of 95% or something of the holding of the net asset value. So that's why some of this is important for the blind spots, but then some are just overly simplistic. And again, this was from the beginning, what I said is some of the most troublesome part. And I think where people get, in practical terms, the most trouble. And so discretionary traders are able to subjectively assess dozens of variables with lightning speed. The daily chart, the intraday, what comparable stocks we're doing, the context of the market, what the level 2 box looks like. So many retail traders, though, I've come to learn, overlook the variable of breaking news. I've learned that most retail traders don't even have real-time news sources to know whether news was ever out or not, which is mind-blowing to me. Because to me and my trading, one of the most important variables is a binary one. Was there fresh material news. If we look at some of the best momentum swing traders, people like Kwalamagi and some of those episodic pivots and everything, the number one criteria for that is a news catalyst. If we don't know whether something has a breaking news catalyst, like that Apple move, right? Say we're blind to the fact that on that prior day, there was news on Apple. You can't really readily explain why is Apple going up 15% in 2 days. And if we're not super honed into this variable, like all of your back tests to some degree are going to be nearly garbage because in general, with news, news tends to lead to trends. News tends to lead to a fundamental repricing of different assets. And news tends to invalidate a lot of mean reversion, or at least make mean reversion very, very hard. So if you have a test, if you have a strategy you're testing and you're not aware of that variable, or if you're not properly tagging some of this data, and you're trying to mean revert stocks that are including news, your data is going to be, you might have an amazing strategy, but because you're missing that one nuance and you're blind to it, you might say, oh my God, this strategy is no edge, when that one tweak might be the difference between you passing on an amazing strategy and you making tons of money. And I think even for a lot of traders out there, if you catch these variables, it can have huge, huge effects on your trading. And even knowing stuff like market context, are low floats running, are short squeezes occurring, are breakouts working? Take semiconductors this year. This has been the market for semiconductor breakouts. This doesn't last forever, though. The more breakouts that work, people start to adapt and the markets change and everything else. But if we were to look at semiconductor breakouts in 2015, 16, 17, some of the moves that we've seen in SMCI, Avago, well, Broadcom now, I still mess that up, NVIDIA, ARM Holdings, unfathomable, right? When have we ever seen multi-billion or 100 billion or even trillion-dollar companies make 30, 40% moves in beautiful trends in a couple of days and everything? There's never been a market where that has happened, and these have been some of the best trends out there. So it's so important to judge these variables. And one story that I love to tell is that of IPOs and the classic trainee mistake that I saw. And I've trained a lot of people at this point. And when I was running an office in Chicago, I was probably training, I don't know, five new guys a year. And one of them would trade every single IPO there was. And I would say, hey, man, what are you doing? Why are you trading all these IPOs? Like nobody else is trading these shitty ones. And his response was, oh, I make money in IPOs. I've crunched the data. And I'm like, what? Like, dude, there's no way you make money in these things. And I'm like, dude, send me the data. Let's go over this. And he sends me the data. And let's say he traded 20 IPOs. He was 100% right. He did make money in IPOs. Let's say, again, I don't remember these numbers at this point, but let's say he made 20 grand across, 20 IPOs. So in his head, every IPO he traded, he makes roughly $1,000 on average. And that for him was his justification. And I think we all make these mistakes, right? We have ego, we have cognitive dissonance. So that's what made him realize, like, I'm good at IPOs. This is one of my best plays and best playbooks. That's why I trade these IPOs. But there was one little thread that he wasn't pulling on. He wasn't looking at the data close enough. If you looked at the data, you would find out that in 4 IPOs, he actually made 60 grand. In the other 16 IPOs, he lost 40 grand. And so the question is, what makes those 4 IPOs that he did so well in so good versus the other ones? Is there a variable? If there's not, maybe there isn't, and no big deal. You do need to trade every single one. But when we looked and did that dive deeper, what we found out is he was making essentially 300% of his P&L in the hot IPOs, like an ARM Holdings or Reddit or any of those. Then he was proceeding to give back 200% of that P&L in the shitty IPOs that nobody else was trading, thinking, oh my God, I have edge in IPOs. And so a lot of times with our back tests, when we don't have the right nuances, we miss stuff like that. So it's so important for us to figure out what are the threads that identify our best trades. What are the threads that identify our worst trades? And you're not going to get that just from backtests or crunching the data. At some point, you need to really use your head and do a lot of the analysis yourself. And like the example I give is kind of the silly one. Let's say my electricity bill is the same amount in summer and in winter. If you just look at the dollar value of my bills, you can't really predict anything about my electricity usage. But anybody with common sense can take that bill and you can say a couple things with very high confidence. You can bet that in summer, that electricity bill is going towards AC. I'm not going to be using the heat probably at all in the summer. But then in winter, I'm going to be using probably all of that bill towards the heat and none towards air conditioning. And by pulling on that thread, you're able to get so much more using logic, common sense, causal mechanisms to figure out like what's behind this bill, what's behind this data. And then even as like another thing where we can go a step further, if we use our head even more, it's near certain summer is AC, winter is heat. So something that's likely but not as certain, and it would surprise people if you don't like think about these things because it's not intuitive. But during both the summer and the winter months, I use less electricity at night than during the day. Why is that? During the summer, when I'm using air conditioning, at night the sun is set. I don't need as much air conditioning. That being said, in the winter, the sun doesn't matter as much, but in the winter, most people want to sleep at a cool temperature, so I need less heat. So you can pull on these different threads and come to conclusions in different ways that you're otherwise just not getting from the data. And these, like I said with the IPO example, have very, very real implications for you. And probably the example that most inspired me to rant on this topic and piss off a lot of people was this happened November 29th of 2023, last year. And this is VVOS. This is a small cap biotech. And what happened was intraday, the stock made a little move towards 20 bucks, not even a little move. It went from 10 to 20 and we consolidate all day. The stock then absolutely explodes when we break above 20 and people blew up. People lost their shirts. A lot of people got absolutely wrecked. And I felt that this was a pretty kind of textbook long setup. And that infuriated people because so many people had got run over. And I would argue, like, look, should you be mad at me for pointing that out, or should we be learning and be mad at our system and just adapt and get better? And a lot of people get lulled into this false sense of security because in general, guess what? Microcap stocks and a lot of these low floats do tend to retrace. It's without a doubt, right? Most of retail Twitter, I think, does a lot of the small cap mean reversion because it does tend to work. But then you get some outliers. So how can you kind of prevent some of this stuff, or how can you be more aware? And so a lot of people were like, dude, no way that's a good long. I've run the data. These tend to go down. These tend to not hold, yada, yada, yada. And what it really came down to was that in all these back tests and all these traders that were short this and all these traders that were just like not even just short, but averaging short and having no stop, they were trusting their system. These tend to retrace. This is really good because it's up over 100%. We're doing a lot of volume and turnover. But they were overlooking some variables. For starters, it was day one breaking news. The same way that I discussed before that breaking news is one of the most important variables in trading, and most people tend to overlook it. A lot of those traders did. This ticker also had a history of squeezing. This ticker was also doing, I don't know if it was all-time high or not off my head, but it was pretty damn incredible, insane volume. This also had an amazing intraday consolidation. For hours, we were consolidating flat despite being up over 100%. The other big thing that's particularly hard to code and adapt to is there were so many biotechs that had microcap biotechs that had been mega squeezing. And I had this tweet around that time. It was VTGN, SLNO, RNAZ, TPST in just the last couple months. That tells you that the market environment has changed. The context is different. So when so many traders out there do their historical analysis and their system says, hey, most of these do retrace, this is not the same back test saying, oh my God, microcap up X%. Sure, it's eventually going to retrace, but that's like, it's too simplistic and you're getting the wrong conclusion. So then I had some of the quantitative traders that I work with run the back test with the variables, the appropriate ones, the more nuanced variables. What did they find? They found that this setup actually had massive edge long, and it was a setup that they ended up taking and developed into their playbook as a result. And any time that you're on the wrong side of that, you need to adapt and listen to the market. Because generally, right, whether you think so or not, if you're blowing up or if you're taking some losses, there's generally almost always signal to those big losses. Not always, but nearly always there's something to learn from them. And so what now? What does it really mean for the people listening to this? What I want to emphasize is this doesn't mean don't use backtests. Generally, appropriate data and being aware of the limitations, is better. And like, it just helps you identify the environments when trusting a back test is most dangerous and what things you might be overlooking. So you want to set rules on just when to adapt or when to override. And you want to make sure, like, does your system have safeguards for shutting down or adapting strategies for when prior data might no longer be pertinent? Or do you have alternative methods to also help make better trading decisions? What are some of these alternatives? Like, okay, Lance, like you're saying backtesting isn't always so good. What can I do instead? For starters, forward testing. Forward testing is, rather than working backwards with data, you work forwards. So, for example, with the CPI in 2022, nobody had good data. And even though I'm trading on some of these other methods that I'm going to discuss, you easily could have started to collect data points. Okay, we've seen one or two or three hot CPIs now. How did the market react? What instruments are going where? What instruments have the most lag? What instruments offer the most liquidity? What is my game plan based on the couple examples I'm going to see going forward? Another way is understanding, having a framework for understanding price action. I have, and this is pretty much what I rely on most for the record, is having a framework for price action and having a framework of technical analysis. I hugely rely on what the chart is telling me. I have a system for understanding what charts tend to make moves and everything else. And so when I look at that VVOS, I view that as a beautiful intraday setup. It's got a resistance level. We've got hours of consolidation. We're doing huge volume. We've got a breakout on massive volume. I've got a framework for viewing all those different variables as bullish and all of them aligning. And a lot of variables are coming together to make that specific long setup very appealing to me. Another alternative is you might have an understanding of the causative mechanism. Why is something happening? So going back to CPI, for example, even if you've not seen a single data point, there's a lot of people that understand if we get high inflation is going to be, of course, a worry for the Fed. The Fed needs to counteract that by raising rates. Generally, raising rates is going to be bad for stuff like tech, stuff that doesn't have much cash flow and it's dependent on future cash flows. There's a lot of stuff that's very rate sensitive. And so you can understand the mechanism of what might happen. And so there were a lot of people that were game planning for what happens if we get inflation. And then you can run that playbook without collecting the data. That doesn't mean you'll always be right, but it's just another alternative. And you really often want to use a mix of methods, and especially the right method for you. So backtesting, for example, it tends to favor those that are strong with statistics and programming, those who are more methodical, slower, deeper thinkers, those who might wish to pursue more programmatic strategies. As we know, if you're a discretionary trader, that's the opposite of being programmed. And a lot of programs kind of rely on backtesting. There's stuff like Jane Street Capital and Jump Trading. All of those type firms, they do a lot of the backtesting. Forward testing, jokingly, is for those with less patience, but it's more so for the tinkerers and the people who tend to be the hands-on experimenters and are willing to have less certainty, but be able to act faster, and with less in more situations where you might not have data. Then for the framework for understanding price action, these are for more of like the systems thinkers, the people that want to make the quick decisions, act first and test assumptions later, and the more discretionary traders, the Druckenmillers of the world. So I would say, again, I'm mostly under this category, and I recognize that that allows me to act in a lot of situations where other people might not be able to act as quick, right? If you were to take earlier this year, this ticker Golf Lima, which had this fraud report, I had some data, like I had some back tests that I had done for fraud reports that are down, stocks that are down a ton on fraud reports. But I then also understood the price action. I understood the volume capitulation we were getting. I understood the price capitulation we were getting. I understood that this was making multiple legs. So in that specific trade, I had a mix of data backed up behind me. And then I had the chart patterns, and I was able to combine the two, which ended up being very, very powerful. Then finally, the causative mechanism, why is something happening? These are kind of the analyzers, the portfolio managers type personalities, the Ray Dalios of the world. And so all of these methods on their own can be incredibly effective or incredibly ineffective. But when you start to combine these two or three or four methods, whatever you're most strong at, that's when you can be really, really powerful. You can have some of the things where you can be as adaptive as a day trader, but then you can be as data informed as a programmatic trader. You can know that, like, okay, recently we saw IWM spike the last couple of weeks. There was a mechanism there where all of a sudden, CPI is starting to change. There's a big sector rotation, but you can also figure out, like, what does the data say? What happens generally when IWM is up this amount in a matter of days? Then you can also just trade the price action. Are we capitulatory? Is this a pattern? Is this something you want to be long? Maybe it's a momentum pattern where, look, CPI was a news catalyst. IWM made a multi-standard deviation move higher, while the stuff like the Qs and the NASDAQ were lower. That signals rotation. We've got a news catalyst. We've got huge volume. We're closing strong. Do you take that as a momentum trade? A lot of these methods can help inform that decision and make it way more effective. So my question for you is, what best fits your trading? Are you taking advantage of your unique strengths and skill sets? Have you thought about the limitations of your strategies and in what environments you might want to push risk versus pull risk back? And what blind spots might you have in your trading? And so that is my presentation with the usual disclaimers. So yeah, Richard, let's talk about it. What'd you think, and what can I answer questions on?
Well, first of all, Lance, I think that was great. And when you're going through kind of the key things that you think about when you think about the limits of backtesting, one more that I was actually kind of thinking about, and I've kind of run into my own, I've done some kind of basic Python backtests of different strategies and indicators and that type of thing, is survivorship bias and hindsight bias. So I just want to hear kind of your thoughts on that, but first kind of my experience and kind of explaining how that impacts things is, I'm more of a longer term trader, especially compared to you, more of a swing to position trader, holding a few weeks to capture kind of those momentum moves from breakouts typically. And if you go back and test that basic strategy, say it's a break above the 21 period moving average on the daily, a very simple sell signal, two closes below that same moving average later on. But if you test it on NVIDIA, it's going to work and have amazing results because NVIDIA has done amazingly over the past few years. So something to kind of combat this that I've done is you test over a wide variety of stocks to try to see, overall, is there an edge there? Overall, do the metrics make sense in terms of win rate, average gain, average loss? But you also have to be careful there because if you test on the NASDAQ 100 now, it wasn't the same, 3 years ago that it is now. So there's still some survivorship bias. So that's one more thing that, I kind of think of when I'm taking into account the limits of backtesting. I don't know if you had any kind of additional thoughts to add or that's something you think as well.
Just both great examples. And I think all that falls under some of like the faulty assumptions we might make. And so often, as I think it was Richard Feynman says, like we're the greatest fool ourselves. We're the easiest person. The easiest person to fool is ourselves. And especially in trading world, there's a lot of just like cognitive dissonance that goes on, and especially like selective memory. Because here's the thing. How often do you just remember all your winners and like like the amount of times where I've seen traders think that they're profitable in some strategy, but what happens is they have a couple big winners that stick in their memory, and then they forget about all the small scrapes. And that's not being like malicious or that's not being ignorant. It's just a
Right.
total, like, we are susceptible to human biases. We are susceptible to cherry picking our data, not just us as traders, but even like scientists. There's so much scientific research where it's like, oh shit, like we actually didn't properly control for some of these biases, and now everything that we thought was true is wrong. And so it's definitely something you need to be extremely cognitive of, and especially the survivorship bias, right? It's like when you look at some of the performance of some of the best stocks in the S&P 500, it can be really, really stunning if you look at an Apple or an Nvidia. But then guess what? How many stocks were then removed from the S&P as they started
Right.
to suck, then eventually went to zero? And if you think about it, like what percentage of the S&P 500 from 30 years ago are probably now totally bankrupt? It's probably some crazy percentage. And so all these things are really, really important. And I think that's where it's like you need to be so intellectually honest with your data to make sure you're not just using hindsight or everything else. Because think about even with some of those examples with say like the VVOS breakout, you need to make sure where it's like, hey, I can think of five really big winners, but you need to also wonder like, man, how many of those might be losers, but I just never took note of them because of the fact that they weren't standout. Will that mess up my data? So it's a huge consideration without a doubt about it, and it makes some of that backtesting very tricky. And not even just backtesting, it makes all of our analysis tricky because we
Right.
are susceptible to just having false data sets and false biases in our head.
Yeah, kind of along those lines, one of my kind of least favorite tweets to see on Twitter is if you invested $10,000 in Tesla 5 years ago, here's what you would have now. Because it forgets everything that happened along the way. It forgets all the other stocks that looked amazing, like
Yeah.
Tesla, that
What could
was
have,
just
yeah,
sort of
all that could have been Teslas. You want to know a
right.
funny one too that just speaks like I think also as just humans, it's very, very hard for us to keep track of a lot of data.
Yeah.
And there's just so many times where it's like if you ask the average trader, hey, how much are you up in X strategy this year? Once you're talking like 70, 80, 100 plus data points, I don't know how close you can even remotely be. And so one thing that we always giggle over is, and this is kind of pre-COVID and everything else when the market changed, but it was maybe back in like 2016 or 17. The one of like the head trader of Trillium, like essentially like the risk manager or whatever,
Hmm.
he sent out some email that was like, public service announcement, dear everyone, despite what you think, like, you all do not make money trading SPY. And like people would trade SPY all the time, whether it's like Fed stuff or this or that. And like, not to say that there wouldn't ever be winners, of course there'd be winners, but most people's like the proportion of how often people would trade SPY versus the P&L was like laughable. And he's like, dear everyone, like the firm is like net negative in SPY over a very long time frame. Like if you keep on
Yeah.
trading this, like I don't think you guys are actually making money. And so I remember one of the guys in the office was like, what? Dude, there's no way that's true. I'm great at trading the SPY. And then so we have the tools to crunch that data, pretty quick. And he looks it up, and then all of a sudden he's just real quiet, and we're like, hey man, like what does the data say? Why are you so quiet? And he's like, yeah, not as good as I thought. And I think like there's no malintention there, right? It's just that it's very hard to grasp some of this stuff and keep these mental tallies and everything else.
We're human. Yeah.
Yeah, we're
It's
we're
tough.
very human and very fallible, which is amazing that like we can have as much edge as sometimes we do.
Yeah. And a lot of people when they think about backtesting, they first learn about trading, they learn about backtesting, and they're like, all right, this is how I'm going to find my edge. I'm going to find the perfect moving average to use, the perfect whatever. Um, but again, because there's no perfection and there's so many nuances as you mentioned, what can people do instead of going down that road? Where can they learn to develop edges? And what process should they take to kind of improve those if backtesting isn't the only answer, it's not the only way?
Yep.
What's a better system, I guess?
Yeah, and so first to even run with your point, like, because I think there's some other cool examples regarding this, which is most academics that have studied technical analysis, I don't know, pretty much every study they do ends up being, hey, technical analysis has no edge. Well, guess what? There's got to be some edge because, right, I've done billions and billions of shares. You can't ascribe that to luck. Like it's, as an active day trader, I've done on the average year thousands and thousands and thousands of trades over almost 15 years now. And when you get that level of skew in the data and it's replicable, like the same Buffett arguments, right? I've been able to teach
Right.
people to do the same things. I've run an office where everyone else was doing the same things, yada, yada, yada. And when you look at some of the analyses that they're doing in academia, you're like, oh my God, of course there's no edge. Like if it was that easy, like again, to my point about backtesting, they're trying to find edge in something that's just way too simplistic.
Right.
Oh, wait, if the average stock crosses above a moving average, dude, if it was that easy, like again, that would already be arbed out, and it is. That's why there's no edge. It's the same as saying like, oh, Warren Buffett, fundamental analysis, you just buy cheap PE companies. It's like, no, it's not really how it works. What makes Warren Buffett so good is a million nuances of analysis that you're not doing in a just low PE screener, right? And so the very important question is, so then, okay, if you're a newbie and this backtesting isn't going to, be nuanced enough, like where do you start?
Right.
And my answer is going to pretty much always be reverse engineering. What does that really mean? It means take the really crazy moves and just start to document and write them up. Okay, what were the big moves this year? Off my head, there's stuff like GameStop, there's stuff like ARM, there's stuff like Nvidia, Avigo, the semis. We've seen some decent crypto moves. Like whatever you think were the really good things, and just upload or just run a screener. What's doing the most volume? What's up the most percent? What's up the most on the month? Um, and start to check that out, and even look at IWM, right? What made IWM move like that? Why is an index up 4%? Why on some of these days is an index of a bunch of stocks moving 2% in 30 minutes? And reverse engineering, once you start to get enough data points and you build up these databases, you can come to a couple conclusions. Okay, like IWM, that move looks like it kicked off on a news catalyst,
Right.
CPI. Huh,
Right.
is that coincidental? Maybe, maybe not. I need more data. Okay, VVOS, the day it went from, I mean, the prior day was at 5, we opened 10, then we go to 45. Let's look at that. Okay, that had news that day. Okay, maybe it's coincidental, maybe it's not. And I think if you look at some of these big movers, and if you're a swing trader, if you're a trend follower, if you're looking for some of these bigger picture moves, I think you will find that a lot of them do come from news catalysts. So then that's one factor that you can start to think is important. I think another factor is very, very high volume, signifying, hey, something's changed, right? IWM or an Apple breakout or any of these tech breakouts. And I think if you start to work on some of these criteria independently, you get a lot of stuff that can kind of look like some of those episodic pivots, like the Qualmagi stuff, or it can look like something just new and special to you too. You can study different nuances, like what is potentially sentiment? Can we find data points where it's like, oh my God, sentiment was, really, really shitty. Now something happened where all of a sudden there's a big change. Um, what happens to stocks that are breaking all-time highs? What happens to stocks that are breaking all-time highs on really high volume?
Right.
What happens to stocks breaking all-time highs on high volume with the news catalyst? And you can start to build these databases, and you can start to pull those threads and figure out like, wait a second, hey, that electricity bill is exactly the same, but I'm able to reverse engineer that in the summer it's being used for AC, and in the winter it's being used on heat. And if there's a way for me to make that bet, there's probably an edge there. And so it's
Right.
figuring out like stuff like that. What happens to stuff with high short interest? And so really going through and building those data points and thinking critically, and then pulling those threads, then back testing. That's a way that can also help.
Yeah, I love that. And one thing you said along those lines earlier on, like looking into what creates trends, you said news leads to trends, and I think that's a great, you know, golden nugget there that I took away. And you I think a couple weeks ago shared kind of a template that you use kind of when you're looking back on these opportunities for July or whatever. We'll try to put it up there if we can, but just kind of talking through it. You talk about keeping the date, the ticker, the P&L if you traded it, the category of the trade, the context, was there news, no news, add in a daily chart, an intraday chart, level two box, how I traded it, how others traded it, how should I have traded. All these are kind of questions that you can use to pull those threads and identify, what was special about it, what were the characteristics that led to this move, that I can then apply that template later
Yep.
on. How
Yep.
can I find, yeah, go ahead, please.
Most traders, I would say, and I think this is like a good analogy. So if you read the Tiger Woods book by his swing coach, one thing that stands out about Tiger is never ever would he hit a golf ball without being very deliberate. What am I trying to work on? Where am I trying to place this ball? If that happened, why or why not? What could I have done better?
Right.
Extremely deliberate. And I think we can agree, like, are you better off hitting 100 golf balls and doing nearly no analysis, or are you better off hitting 50 of them and being very deliberate about it? And I think the analogy here is, as a trader and as a new developing trader, there's probably a lot of traders that are probably trading too much and doing too little analysis, and too light on the nuances of the analysis. And so I think if you're going to do a trade, especially as a developing trader, it's so important that you're very intentional and you learn and you try to pull on those threads and suss out those details. And if you're doing a trade, you really want to go back and figure out, like, okay, why did I trade this? What was the setup? What were the variables that made this good? How should I have traded it? Like, what should my executions have been? And like, what should the edge and everything else have been? And then collecting some of that data kind of going forward and everything else, or backwards. And I think that deliberateness, that's where the real growth happens. It's not comfortable though, right? Like when you're it's so much more fun to trade and like get
Yeah.
the dopamine hit and everything, and oh, win lose, and you feel like a trader. It's the way harder work once the market's closed, where you need to then sit there and review and figure out, did this make sense? Is this something that I was supposed to be trading? Why do I think this ticker has opportunity at all? And even so many people, because you brought up the level two, which I have in my analysis,
Mhm.
there's so many people out there that say the level two has no edge. It's all algorithms. It's all useless. And I would argue, like, again, it's almost like the same argument with technical analysis. Like, sure, I mean, yeah, look, the level two in SPY, I would agree, is probably nearly useless for the most part. But that doesn't mean all level two is always useless. And can you find those opportunities where something's really, really different? If you're a mean reversion swing trader, can you find on this most recent GameStop pop? Can you, when Roaring Kitty was doing the live stream, can you identify that after hours into 8 p.m. it was just one ARCA buyer driving that stock up? Then the next morning, that ARCA buyer was just totally cannon fodder. And once the ARCA buyer was done, it was game over for that stock. Then there was the offering and everything. But can you identify turns like that? Or on a breakout, if you're going with the trend, can you identify, like, just how big the buyers are? How aggressive is the paying? Is anybody hitting the bid? Is anybody selling? How, like, just those
Right.
things can really matter in a breakout. Like if you were to watch the breakouts of SMCI, Apple, Nvidia this year, a lot of these, when it breaks that level, it's just absolutely gone. Like if you're trying to get hit on the bid, or you're trying to, like, fight over pennies, those breakouts are gone. Do you not think that that matters? Do you not think that the best breakouts this year have not looked back? Then we talk about selection bias, right? Because it's almost by definition, some of the best moves don't look back. So if you're the trader that is trying to always get in on the pullback, are you perhaps leaving yourself more susceptible to the ones that are about to fail,
Right.
and then lopping off your asymmetry on the ones that are going to work the best? And so I see a lot of traders that won't buy that initial break. They want confirmation. They want it to go, then pull back. But then I think if they were to look at their data and pay attention to that nuance, they would realize, oh my God, the best setups, the Apples, the Avagos, the SMCIs, the Nvidias, Those break that level and they're gone. Why are they gone? Again, what's the causative mechanism? It's because everybody recognizes, holy shit, this is an amazing setup and I need as much stock as I can get. And they don't pull back because no one wants to sell at $200.50 an Apple. Nobody wants to sell 201 in Apple or wherever. And so you're not getting the pullback because everyone says, wow, that setup there, that was a spot. And so those nuances in these write-ups, it really, really matters. It really matters in your analysis. It really, like, that price action is a tell. And if you're never taking the pause to analyze and observe that, whether you're a swing trader, day trader, whether you're a trend follower, mean reversion, that stuff matters. What happens when you get a capitulation and boom, it's just done? Like that thing is just dead as a doorknob. It can't bounce. That is a way different thing than, hey, we capitulated and now we're curling back up and we're consolidating up there. That's way different. That stuff matters.
And when you're doing these write-ups and looking back on either stocks you traded or stocks you didn't trade, um, how can you kind of try to be as intellectually honest as possible? Because again, we've talked about how we can fool ourselves. This is the obvious buy point, but in the moment, it might not be obvious because things are different in real time. So, are there any kind of tactics you use or procedures that you use to try to get the most out of each write up and try to be as objective and honest as possible with yourself and your own abilities, your own way of trading?
It's going to sound really corny, but the more you tie your identity to performance, the more you're going to struggle. Like if you're afraid of making mistakes, then you're not going to have a fun time and you're going to do yourself a dishonest disservice.
Hmm.
And the more you view that you're like every day, my goal was to get 1% better. My goal was not to make money, right? Obviously, that's the end goal, but that I knew that's not the process of how I was going to get there. And so if my goal is just simply to get better, and if my mindset is how can I get better today, I'm mentally open to those mistakes and I'm actively trying to find those mistakes. What am I overlooking? What could I have done better? If you're just not focusing on that and you're not emotionally open to that discomfort and you don't view that as how you grow, like that's a huge difference in mindset. And the person that has more of that mentality, that's when you start to justify things and say, oh, this didn't work out so poorly because I'm unlucky, or the market's just been choppy lately, or this or that. You're less likely to take accountability versus saying like, look, every day I'm just trying to find what I can do better. I'm accountable every day. And growth is just improving. And I think that mindset of saying like, I want to find these mistakes. Every time I took a big loss, like I retrained myself to think good.
Hmm.
This was a big loss, but I found that vulnerability. I found that vulnerability and I fixed it. And I would just think like, oh, that's a patch for my armor. There is a hole right here.
Right.
And, a hole here almost got me in the heart. It was almost fatal. It was here. Now I know I need to reinforce this. And when XYZ happens, I need to be way more like, so you're better. You're actually a more resilient, robust trader because of that. And like, I trained it's uncomfortable, right? Like you just took a huge loss. Um, but having that mindset makes you just way more, I guess, open and adaptive to these things over time.
I like that analogy of patching your suits of armor. That's a good one. That's a
Yeah.
great way to put it. And this next question, it's more about going to a trading question versus kind of a little bit what we've talked about with backtesting. But you mentioned, the key themes this year and how important it is to key in on them. Whether that's AI, semis, small caps recently, the social media stocks. What are you kind of doing in the moment to identify those as they're very quickly developing and um, just becoming an important theme because they go from CPI, as you mentioned, went from a nothing burger where it didn't really matter to now, all right, the whole market's moving up or down, whatever, on this event. How do you start to notice what news catalysts matter, what themes are developing in the market? I assume, we can make a whole presentation on this topic because it's so important, but what are
Yeah.
kind of your high level thoughts there?
Yep. And I think that's where your process matters. And again, I think anytime I start talking about less explicit, tangible things, like people start to think like, oh, like, Lance is BSing or Lance is hiding stuff rather than thinking like, oh my God, like process and how you think actually does matter. And
Mhm.
so from a process perspective, I was doing a daily report card. So every single day, without fail, I kept this up for years without fail. I mean, unless like, look, sickness, sometimes you're on vacation, whatever. But if I traded that day, I was writing this thing up. And during that daily report card, you can reflect. Like one of my lines is, what was the best opportunity,
Right.
or what did I observe? I also generally would do a weekly review. Each Sunday I'd go in and just study the opportunities from the week, and then I do a monthly review. So I created these layers in my process to help spot these things as proactively as possible. So I think on that CPI day, when you take a step back at the end of the day, you say, "What the hell?" Like IWM is up 4%. The NASDAQ is down. I don't remember. I'm kind of making this stuff
Yeah.
up. NASDAQ is down one or two. Like if you catch that in your daily review, that's like, you're like, wow, that's something to pay attention to. Um, in your daily review, when those microcap biotechs started to go crazy, like even after one data point that does something exceptional, you need to say like, whoa, what happened here? And like
Hmm.
something might be different. Once you get two of them, that's now two data points. And you really want to start connecting threads. And like as long as you're really being receptive to whatever's like, and it's like the Gretzky line. Like you need to skate to where the puck is going. And it's like you don't necessarily need to be there for like that Nvidia earnings call. I think it was I don't know, was it late 22, I think maybe, where essentially it was like the earnings where they guided up and everyone was like, holy shit, AI is real. And then
Right.
it was the cues, to the moon. Like, I'm not saying you need to catch that first one, and often you won't, but you need to say like, whoa, like this AI is kind of the theme driving the market. And maybe you missed the second semiconductor. Like I think it was Avago, Broadcom, or whatever that then
Gapped up
made the
huge.
next move.
Yeah.
Yep. And that's when you need to start to say like, wow, like on the third one, I need to really pay attention. So like as a general rule, I excuse myself of not having. You can't be everywhere. You can't catch everything. So you don't need to catch the first one. After the second one, you want to really be on top and say, hey, this might be a pattern. Ideally, by the third one, I want to be trading it. That doesn't mean huge size. That means like even in the forward testing bucket, I might want 100 shares, 1,000 shares, one share. I at least want to be involved and see like, am I developing a replicable system to capture this? And then I would say like, usually the sweet spot is like, and ideally I'm even doing that on the first and second, so I have my system in place for the third, because like the sweet spot really is like probably the second to the fifth. And once we're talking about the sixth, seventh biotech that does this, or the
Right.
sixth, seventh semiconductor, that's when everybody's kind of on top of the trend, and it's almost like too late now. And if you're waiting for 10 data points, like I would argue, and I'll go out on a little bit of a limb. I would argue we've seen the top in the semis, and I've been pretty public on that view. And if not the top, at least probably peak euphoria with some of the gaps. And look, maybe I'll eat my shirt on this one, but like what happened is once you get, it's now been a year of some of these real blowouts, and I'd say like that arm and
Yeah.
that arm move was pretty damn crazy. Where literally every semi that broke out, it was just boom, 20% or something. Like that's a level of euphoria where then expectations adjust so much higher and everyone's so on top of that. And then you start to get like earnings reports where it's like when expectations are up here, like for you to get a 20% gap or something, it needs to be like stratospheric. So I do think we probably reached peak sentiment. And like if now you're hopping on that trend and you're running these back tests and you think, oh my God, the average breakout's going to return 20%, I would argue just from experience in the context, those are going to compress and maybe even go negative. And so it's just being very, very adaptive through your process to recognize these and say like, okay, like, one is just one data point. Two starts to be, I can make some,
Trend. Yeah.
yeah, and then three, it's like I want to be acting on that.
Yeah, so there you go, folks. Routines matter, daily routines, weekly routines, do them. And you kind of answered my next question, but maybe you've got a little bit more color here. Once you, like you said, once the semis, started popping up, whatever, they've been trending for a long time, started in really in 2023 through 2024 now. What are some signs, and you mentioned a few, that the trend is kind of losing steam, losing momentum, and is a little bit long in the tooth?
Yeah. And that's such an important question. When do things start to falter?
Right.
And so I would argue anytime you get some really big blowout, after that, most volatility spikes tend to be dampened versus that. So take GME AMC the first time, like, okay, mega blowout. My general theory is anything will be dampened against that one. So then Roaring Kitty came back. We blew out to like 80-ish pre-market. My general theory is ones after that will be even dampened versus that one. And so like again, not always like it's just a heuristic. And so like again, when we look at that ARM one and the hysteria, and you can even tell just from like reading some of the headlines, listening to CNBC, like it's kind of funny too. I don't know where SMCI is right now, just having no charts up. It's probably like 800, 700, whatever. And on its way up, when SMCI was going up to like 1200, as we were approaching 1,000 plus, like 900, everybody's target and where people were scared this could go, oh my God, is this going to 1,500? Is this going to 2,000? And it's like what? Like, where were all you people back when this had earnings at $450? Like, I want to hear those views then, not the reflective view where, oh my God, because this is doing that, it just is this feedback loop. And eventually that feedback loop reaches a mania where it just can't build on itself anymore. And so it's like when you start to see the euphoria of every single thing, when every single setup works and every single setup is just exploding, that does not last long. It does not last long. And that's when you like again, I think that sweet spot is probably, in times 3 through 5, roughly.
Hmm.
And when things start to really work and you're like, oh my God, this is awesome. And now everyone's hopping on the trend, that's when I start to pull back. You always want to be one step ahead of the market and not waiting for confirmation, right? And so it's like if I see one CPI, then a second, I don't need to wait for the third. I'm trading that, right? And then once everyone is psyched for CPI, every single person is like, oh my God, I should be game planning these. Oh my God, I now have all the data I need. That's when I'm like, okay, like I'm going to start to pull back. Not necessarily stop, but just start to be more defensive. And the other thing too is initially what you'll see is not that everything stops working, but you'll start to see a couple cracks. And all of a sudden, the setup that used to go 5% goes 2 or 3. Or all of a sudden, the setup that was working 80% of the time starts to work 50% of the time. So it's like almost like the slope of how well things work, where you're like, oh my God, like this semiconductor worked. Now all of them are working. Then you start to see, okay, both the reward and the percentage are starting to falter. And that's when you start to really go back. And then most people, a lot of people though, don't don't stop until after they take losses. And it's like,
Right.
dude, you didn't need to wait for the loss. Like you can see things working less and less. You don't need to stick around to like, take the flesh wound. Like it's okay, man. I think like even P&L at a certain point, like that becomes an indicator in itself. And hey man, when things are really easy, it's rare
Lasts too long.
that stays going. Yeah.
Yeah, I know like early on in a trend on a daily chart where we're coming from a correction, whatever, you have a really big day, it's like, okay, cool, that's the start of a trend. But then when we've been trending weeks and weeks and you have your best day in a while, that's kind of almost a warning sign that I've kind of noticed where, all right, gotta be on guard a little bit now.
Yeah,
That's just
the
something that I've noticed.
sentiment's so huge. Like you're so spot on with that. And like it was even funny when Bitcoin was at, I don't know, it was like what, 67,000 or something. Like every single trader on Twitter and every single trader I know is like, "Hey man, what's your game plan for the Bitcoin breakout?" And like every single trader was like, "Dude, like oh my, like you just saw it." Like I would check out random Twitter posts and like about homes or something, and people would be like, "Dude, why would you buy a home when you can just invest in Bitcoin? It's inevitably going to be up." It's like, what? Like, what are we talking about here, guys? Where like sentiment does reach that fever pitch, then you end up with like, wait, everybody's already positioned for the breakout. Everybody's long when it hasn't broken out yet. And if everybody's already positioning, like, then it's like, wait, there's nobody left to bring it to the breakout. And that's kind of the chumps that make that lower high. And then it cracked, right? Then it cracks, it breaks 60,000, it flushes out to 55, and everyone's like, oh my God, like it's over. That was the lower high. This is the end of the world. like it's just that pendulum that shifts and shifts, and you just want to be so cognizant of like, is every, it's like like even GME a couple weeks ago, it started to perk up towards 30. And I
Yeah.
saw some post where it's like, oh my God, every time GME has broken 30, it's exploded 20 more points. It's like, one, that's like a super stupid analysis because you're only like, first of all, and I mean, this is a great example because when GME had recently broken 30, every time it had done so was on like this fresh roaring kitty news catalyst. So the person wasn't factoring in the news catalyst. The person also wasn't factoring that this has already now just had like a couple big spikes with no news catalyst. And sure enough, like I think it like doinked 30 and now it's just melted. And it's
Right.
like, well, everybody was getting super perked up. Like everyone's like, oh my God, here we go again. If everyone's saying here we go again, we're probably not going again. It's so
Yeah.
it's those qualitative things really matter.
And meanwhile, small caps and IWM are gapping up and they're starting their move, and that's fresh, and that rotation just happens. It's how the market works. So,
Yep.
yep. Lance,
And
this,
even
yep.
with, sorry, but even
Go
even with
ahead.
IWM, where were people the most underpositioned?
Right.
It was probably IWM. People were saying IWM is going to be dead forever because, unlike most indices, their best performers, get into the S&P and they move on and everything, yada yada yada. Small caps suck. It's the mega cap growth, and it's like, well, when everyone agrees on that, it's probably about to end.
Yep, perfect. Lance, this has been fantastic. I just have a few kind of wrap up questions for you. I've really enjoyed this. First, this is kind of a complete pivot a little bit, but I want to hear your take on this because it's kind of one of my new favorite questions to ask. How do you define and also manage risk when you are trading?
Yep. I mean, okay, I'm ready for my 2-hour TED talk. Um, how do you
Next
define
time.
and manage risk? Yeah. I mean, I think at the end of the day, a lot of stuff just needs to come from experience and starting safe. And most people are never as conservative as they think. And ultimately, the best way is through experience and iterating. And no system you come up with is going to be perfect. No strategy you come up with is going to be perfect. And by definition, if we've learned anything from this talk, a lot of times we just don't know what we don't know. And you can be blindsided by so many things. And so the most important thing is to like size way more conservatively, always leave ammo in the tank, and just give yourself the most important thing, which is the runway to always be in the game to learn and add new patches on your armor. And so the biggest risk is just being out of the game. And so maybe that might be having in prop trading world, we had daily loss limits. You were never ever going past your daily loss limit. That
Right.
should be just such a common practice. It's different if you're a swing trader and you're potentially up on the trade, right? You sometimes you need to give back some gains depending on your system. But as far as like percent of account in a single day, you always want hard coded risk limits. And you always want to um, even live by this heuristic, which I recently started using and thought up, which is only allow yourself a loss that will not impact your psychology. Because for a developing trader, having a positive feedback loop is so important. And when I train and mentor all these guys, the most damaging thing these young guys can do to their career is you end up in this hole or this drawdown, or you take some loss where it really kills your motivation. Because the most important thing is just making forward progress each day, just getting that 1% better. And so what I realized when traders are like, "Oh, how much should I size up on my A plus setups? How much should I size up if I want to grow?" My answer started to become like, if something is truly A plus for you and you want to be very aggressive, definitely push it, but never go so big that taking a couple losses will then affect your psychology. And I think that's just such a good little rule of thumb. Because it just allows you to always compound and grow. And so as long as you have rules to protect you and keep you out of the game, or sorry, keep you in the game, and as long as you have rules, ideally even stricter than that, which affect and prevent your negative psychology, um, that's kind of how I think about it these days. And for anything more specific than that, it's like, well, that's kind of the fun.
Yeah.
That's on you and what you learn along the ways by taking all those, little flesh wounds. And there's no way to avoid that. Nobody can ever do that work except you. And that's what makes you unique and robust as a trader is that you've taken those flesh wounds. And it's part of just paying the dues. There's no way around it.
That's a great answer. And Dr. Steenbarger actually last weekend was talking about positive trading psychology, that positive feedback loop where you got
Yep.
to keep that confidence up, and that's going to allow you to trade better and better. So I love that. Um, Lance, if you had one homework assignment for everybody watching right now that they could do to improve their trading, maybe it's along the lines of filling out a few of your templates and analyzing some of the best opportunities. What would that kind of homework assignment be? What homework would we give everybody watching right now?
Yeah, one homework assignment, probably the most important one, if I had to do one, is take what you think are the 5 examples of your most quintessential setup. Like if I were to say, okay, what is your setup? What's your edge? Take the 5 absolute best ones in that trade and dissect them in extremely high detail. Every
Mhm.
single nuance, every single variable involved, exactly how you should have traded it. What's the entry? What's the trailing stop? What's the stop loss? What size you should get? What percent of risk? And do that for 5 examples, and then make a master document. This is the play. These are the variables. This is what makes it better. This is what makes it worse. And if you just have imprinted in your mind, like the analogy I would give is there's such a huge universe out there of stocks. There's so many setups, everything's moving. To know what not to trade, there's actually an infinity combination of what not to trade. It's
Right.
overwhelming to study what not to trade. What's way easier to study and to learn is to say, I'm going to imprint this one super specific pattern. It might not occur all the time, but I'm going to master this super specific pattern. I'm going to scan for the super specific pattern. I'm going to know every variable. I'm going to know every aspect of this, and I'm going to have all the data that's exactly on this, and I'm going to master that. And that's the way better path than trying to fight a universe of just 1,000 different things. Like if you told me, like if I had to teach you poker in one day and and you needed to know the odds of every single hand, or same for blackjack, how do you act in all these different hands? The way easier thing is that if I have like 1 hour to teach you poker, is okay, here's one rule. On aces, you bet, everything else you fold. Like
Fold.
you can
Yeah.
come up with like all you need to learn is how to play aces. I'm going to teach you how to play aces and nothing else. And that's going to get you a lot further than like, okay, here's all the nuances of what to do if you're stuck with 2-7.
Right.
It's just not going to be as effective for people. So yeah, really honing down in the highest detail imaginable. Like if you don't have some multi-page write-up, at least for like 5 charts where it's like, boom, this is a quintessential imprinted in your head, it's gonna be a high return.
Wonderful. I think that's great advice and assignment for everybody. So I expect to see some people sharing their examples on Twitter, tagging us.
Cheating's
We'll
allowed.
retweet
You
them.
can share, you can post, you can collaborate, you
Yeah.
can even use AI.
There you go. There you go. Lance, this has been fantastic. I know you've been working on a resource that you'll be releasing later this year. I'd love to hear more about that, as well as your foundation as well, if you'd like to share a few words on those.
Yep. So the big thing going on in trader world for me is, after many years of kind of just sharing my knowledge and after a lot of requests, I am finally working on creating the greatest trading course of all time. And I mean that quite literally, because I'm pretty certain nobody has ever invested this amount of time or money doing this. I recently posted a trailer on my Twitter, which shows just the quality of production going on. And the beauty of it is the majority of this course, which I've called Magnum Opus, is going to be totally free. I plan on this being the legacy of all my trading knowledge, especially as I want to one day kind of move on from the trading world and pursue other hobbies. And my other big interest, of course, is giving back. Since 2018, I started my own nonprofit, and that definitely takes a lot of my time these days. And what we do is, it's called the Impact Competition, and we host competitions at universities that challenge students to solve different social issues in their local communities. We give them a cash prize. We give them funding to implement their winning idea at the local nonprofit. And we have some really cool success stories on everything from gun violence in Chicago to housing insecurity in rural Indiana. And it's really amazing working with these students. And I think what's so important for traders to recognize, when so often P&L and money is our scorecard, is you can get trapped in this cycle of enough never being enough. And I really enjoy giving back, because it's a reminder of just how grateful we should be. And why I love this conference itself is because it's ultimately sharing free knowledge and trying to raise money and everything. And so the other beauty of what this training course is going to be is it's going to intersect the two worlds. Because I saw this opportunity where there's just so many gurus out there, so many snake oil salesmen, and in my view, they're essentially just defrauding people of their money. There's no real edge being taught. It's all bullshit. And it's sad because I've met these traders in real life. I do a lot of meetups and I hear their stories, and that was really my motivation, where it's like, okay, enough of the bullshit. We're creating the end all be all. And then what I plan to do for part, which will be just a premium version, is then take some of that money, cover my production costs, and then just donate it to good causes. So it's ideally, look, share my knowledge with the world, help people hopefully fare better at this craft, and make the world a better place rather than throw the money into the pockets of just frauds and furus.
There you go. And people can learn more on your Twitter, I believe. Is there a website
Yep.
as well
Yeah,
related to it?
so for the course, it's going to be the1lanceb.com, all spelled out. It's all linked on my Twitter and everything else. And there's a sign up page. And look, I try to avoid a lot of the heavy marketing and everything else, just because I just want to do this for my own reasons. But nevertheless, like, the free version, I think, is going to be a super kick-ass resource for thousands of people. So stay tuned. Come year end, I'm hoping to just break the internet with this one.
Perfect. Well, Lance, you've definitely given back today here to everybody watching. Please, everybody, thank him in the chat. Let us know your favorite Lance quote or key takeaway from today. Lance, thanks again for your time. I really enjoyed that. I think this is a great compliment to last year's as well. And yeah, thanks again for being a part of this. I always enjoy talking with you. I always learn something, and I'm really looking forward to rewatching this back, taking some more in-depth notes. So thank you again, and we'll be right back with our next presenter. Stay tuned.
My pleasure. Thanks, Richard.
Thanks.